Has the latest unemployment data put hold on the Reserve Bank's possibility of dropping interest rates? If you haven't kept up to date, unemployment has dropped. More and more Australians have got jobs, and that's really not what the Reserve Bank was hoping for. And that means that some of those prospects of, well, the Commonwealth Bank suggested there are going to be 6 interest rate drops, 3 this year and 3 next year. Maybe that's going to be put on hold. We're going to discuss in today's Property Insider chat with Dr. Andrew Wilson the various factors the Reserve Bank takes into account when making interest rate decisions. If you'd like to keep up to date with our housing markets, please subscribe to this YouTube channel. And while you're there, why not just click the little bell icon so we keep you updated each time a new show comes out. There was great news on the job front recently. Australia's unemployment rate plunged to a new low of 3.7% in February. But this has raised the question of how well did those 13 interest rate rises work to slow down the economy and kill inflation? This unexpectedly strong jobs market data has cast doubt on the possibility of an imminent rate cut. Many borrowers were hoping for some relief in interest rates sooner rather than later. Prior to the February figures, there were talk of rate cuts by the middle of this year, but many economists were predicting cooling labour markets in response to the Reserve Bank's recent series of interest rate hikes, and they thought rates would start to come down. Remember, if unemployment rises, the Reserve Bank may worry about a slowing economy or even the possibility of a recession, and they may have started to cut rates. However, the February figures paint a very different picture. Not only did unemployment fall, but a significant number of new jobs were created. And this robust jobs market data has got many economists scrambling to revise their interest rate predictions. Interestingly, not Dr. Andrew Wilson, who I'm going to chat with about this in a moment, because he was a little bit more cautious about what's ahead. Now, many analysts believe the banks are going to hold or even increase interest rates because low unemployment could contribute to inflationary pressures as businesses compete for tighter pool of labour and potentially leading to higher wages. Of course, this is exactly the scenario the Reserve Bank was trying to avoid. So what does this mean for our economy and for the future of interest rates? That's one of the questions I'm going to ask Dr. Andrew Wilson, Australia's leading housing economist and chief economist of My Housing Market, in this week's Property Insider chat. Hi, Andrew.
Yes, good day, Michael. And finally, some validation of what we've been saying really for months. And that's really this head-shaking nonsense that's been coming out of a number of sources in relation to interest rate cuts in Australia, which couldn't be further away, really. And the data as it's coming through is pointing to that outcome increasingly. And maybe some of these analysts and economists, financial journalists who have been predicting this should be looking for employment in other fields where they could be a bit more successful. But certainly the latest data continues to show that the impact of interest rates on the Australian economy has been negligible. Of course, we went through that big pause getting onto a year ago, which was highly questionable. The Reserve Bank was forced to backtrack and raise rates later in the year because inflation had started to rise again. It begs the question, really, have rates done anything? Well, the answer to that is really no, particularly given strong labour market data that we had. But we need to take that with a grain of salt, Michael. That data has been up and down. The ABS does concede that its seasonal adjustment modelling has been put out of whack by COVID. It'll take some time to get that normalised to some degree, but it was unequivocally strong data for the labour market. Again, we're in a boom economy, near record low unemployment rate, surging employment, and sharply falling unemployment. So this comes off 12, 13 interest rate increases since May 2022. So it's really done nothing. And then we look at inflation. Yes, that's fallen sharply, but really that's tracking the price of oil. And we'll look at the price of oil, how that's moved today. But unfortunately, that's on the rise again. That's certainly not good news for the outlook for inflation. And once again, is bringing into question that, as we've discussed, the certainly still likelihood of having higher interest rates in the future.
Well, we know that in March, the Reserve Bank left interest rates on hold. This was the third consecutive steady decision by the Reserve Bank. But what does all this mean now with the jobs data, the retail figures, and all the other bits?
Well, yes, the Reserve Bank predictably left rates on hold over March. Of course, the meeting was a little later this month, this March. Usually days gone by, we had the Reserve Bank meeting the first Tuesday every month. It's now only 8 meetings. That was 11 meetings per year because they didn't meet in January. But now We have 8 meetings in the revised Reserve Bank agenda, and this was a little later now. We won't have a meeting over April. So that was the third consecutive steady decision by the RBA. We've had, as I mentioned, 13 rate rises since May 22. The economy is still strong. We've seen that latest labour market data, which is very strong, and retail sales are still high. Inflation is lower, but it's still too high and ahead of the target range for the Reserve Bank. And the concern is that higher fuel prices will reignite inflation in the shorter term. Fingers crossed that doesn't happen, but signs aren't good. I thought it was interesting, Michael, when we look at the commentary from the Reserve Bank's decision last week, it was very neutral. When we discussed the previous decision, the February decision, the Reserve Bank actually was quite hawkish. They were saying quite clearly that, look, don't rule out another interest rate increase. And that was picked up by a lot of international media, saying that the Australian Reserve Bank, because at that stage, the US particularly was still going gung-ho on interest rate cuts potentially. And they were saying, well, look, this has gone against what everybody else is saying. Other central banks are saying that the Australian Reserve Bank had said, well, look, we still can't rule out higher interest rates. But I thought this month its commentary was very neutral, Michael. It said clearly, and I think the key statement was that the board was not ruling anything in or out, so it was just taking a very even-hand approach without saying one thing or the other in terms of whether the outlook was for higher or lower interest rates. And I think that was a little bit of a cop-out from the Reserve Bank in terms of the outlook. And I think it's sort of moving into a much more insipid, neutral type of stance in terms of its view of the economy and the outlook for interest rates. And I think that it's got to comment on changes to the data as it is coming through in the shorter term, rather than saying, well, look, we're waiting for things to sort of evolve. So I'm not sure where the economic insights are being generated at the Reserve Bank, but certainly there was nothing to grab from what the Reserve Bank said in its commentary in relation to its decision last week. We'll wait for the minutes to see some further insights from that. But I did think it was a big change from the commentary that they provided in February, which was more direct in terms of its opinion of the economy. So interest rates have and the direction of interest rates. And the interest rates are certainly now flattening out. No surprise. I think we've got to understand, Michael, also that Australian interest rates, official rates, are still the best part of 1% below the US. So any chat of cut to rates here, independent of the US, even with the US cutting rates, would expose our currency because we'd be falling backwards against the US dollar, given that our interest rates are significantly lower already than the US. But as I said, this is just clickbait, these projections of interest rate cuts. And it's the roller coaster flip-flop of commentary on economy, which is frustrating, head shaking. But again, it's up to the public to sort of make their decisions on where they get their information. And let's hope they're not making decisions on this bounce around in interest rates. But what we've done today, Michael, which is a little interesting, is looking at those variables, if you'd like.
Let's make it clear. The Reserve Bank's job is to keep inflation within a band of 2 to 3% and keep our economy chugging along nicely, but not too quickly or not too slowly and fall into recession. So we talked about inflation and we talked about employment, but the Reserve Bank probably has a look at a whole lot of variables, doesn't it, Andrew? What are the many factors they take into account when they make their decisions?
Well, if we take an analytical approach to the outlooks for interest rates, Michael, I think it can be revealing and look at those variables, as you mentioned. And if we go through them all and perhaps give them an upward arrow or a downward arrow or a steady arrow in terms of what it means for the outlook for interest rates, certainly inflation is the big picture. That's our view. We've had inflation rising at the highest levels for decades as a result of that mismatch between supply and demand from the COVID period. Inflation has fallen sharply. The latest data on inflation has shown that the recent sharp falls have now eased. In fact, headline inflation was steady over January, showing that the track of inflation, the decline in inflation, is starting to ease. We expect that because the last little bit is going to be the hardest. And the key drivers of inflation are still there, and that's particularly oil prices. And we've done this analysis before, Michael, where we show how oil price declines have tracked inflation declines. This is the case everywhere, really, that falling inflation really has been a product of falling oil prices. But the bad news, and we'll look at the charts shortly, is that oil prices are on the rise again. So that is certainly a negative for any thought of a cut in interest rates and positive for higher interest rates. House building costs are another key factor in the inflation rate. House costs have been a consistent driver of higher inflation. And a key part of house costs are those house building costs. And they've bounced back over January and on the rise again. So that's another sort of upward arrow for interest rate prospects, Michael. Home rents, of course, as we keep revealing here, are still on the rise. Bad news for tenants. That's another upward arrow for the potential of interest rate changes. And the jobless rate is falling, and we'll look at the numbers shortly, Michael. Very strong numbers over February for the jobless numbers. So that, again, is upward pressure on interest rates, although the Reserve Bank would be happy to have a strong economy as long as it didn't push wages up, which then pushed up prices. So retail sales are rising, but the trend has certainly flattened out. They're still high. I'd say that's a neutral impact on rates. House price growth is continuing. The Reserve Bank, in my opinion, pays too much attention to housing market outcomes. But it certainly would be trepidatious from its point of view as house prices increase in terms of it being a consideration for falling interest rates, which may only push up house prices even more. So I'd say that would be a neutral at the moment for interest rates. We mentioned the US rates are still well ahead of Australia. So I think that's a neutral, because I think we'd have to wait to see US rates cut before we even considered cutting our rates, considering we're well below that. And that focus in the US and Europe has certainly changed from interest rate cuts, which were almost hysterical predictions of that the end of last year and the beginning of this year, Michael. And economic growth is slowing in Australia. Still positive, no sign of a recession, but it is slowing, and that's a downward arrow for the prospect of interest rates. So if we put all those arrows together, Michael, for those key factors, I still think that we're looking at an outcome on hold, but I do think the bias is now shifting to an interest rate rise, given the latest data, Michael.
Well, that's going to disappoint some people who are expecting a lower interest rate and lower mortgage costs for a while. Clearly, there are people hurting in the economy. So while we're saying the economy is strong and job growth is strong, the cost of living has affected a portion of the population. But we've got to remember that a third of Australia's population rent, and so they're not affected as much by interest rates, even though they're affected by rising rents. Half of the homeowners don't even have a mortgage. And so in some ways creating two tiers, isn't it, Andrew? Those who own property, they're doing really well at the moment. Their properties are going up in value, rents are going up, and some people don't even have a mortgage against those. So it's going to be good news and bad news for people, these sort of results. Now, we spoke a little bit about oil. You mentioned that a moment ago. Let's make it clear, you can see quite a clear correlation between the price of oil and inflation.
Well, there is a correlation, Michael. We just have to track the cycles for both. We know interest rates, surprisingly, were increased after a period of flat results last year by the RBA through the middle of the year, and then they backtracked and increased rates. Well, that was on the back of a higher oil price. Just have to look at the Bowser at the moment, Michael. Prices are $2.20, $2.30 in Melbourne here, and that's back to the old days. And will the government step in? And again, if we do get oil prices higher and provide some assistance, this is really a vexed question for governments. I think that OPEC, who are the oil exporters, have decided that they want to get back to the good old days of over $100 US per barrel. We've seen oil break through the $80 US barrier. Where we'll really have alarm bells ringing is where the resistance level of $90 US a barrel is breached, if that occurs, because then that will really create upward momentum, and that will have significant impact on inflation, and it will certainly kill any suggestion of lower interest rates, because in fact it'll start to bring the higher interest rate call into focus. But I'm not saying this is going to happen. I'm saying that the trend is clearly now upward for oil prices. OPEC have said that they're going to consider reducing production so that they can push prices up higher. So not good news there going forward. So we've just got to hope that current upward trend breaks even and starts to move downwards in terms of the outlook for interest rates.
Well, I'm sure you'll be keeping us updated on that now, weekly Property Insider chats. Now, one of the other factors that's in the news a lot is overseas migration booming. And while that's not directly taken into account by the Reserve Bank in its decision making, clearly it does have an indirect impact in many of those things you were talking about, particularly our housing markets.
Yes, latest data from the ABS just confirming very strong bounce back from the lockdown period, Michael. It's a vexed question because obviously this bounce back in migration is creating high demand for housing. We're already undersupplied, reflects a large degree of the mismanagement of our housing markets policies over the past decade. We're stuck with it, unfortunately, and there's talk now from the government of starting to ease particularly temporary migrants to take some of the heat out of those undersupplied rental markets markets particularly. But the latest data, some interesting points, and it is backdated data. This is the data we'll discuss today, is the year to September last year. So that's going back a bit, Michael, but nonetheless, the trends are still pretty strong. When we look at overseas migration, New South Wales is still the leader there, Michael. I think we're getting a lot of expats still heading back into New South Wales, into Sydney, and that's part of what's driven that Sydney housing market. Again, this is backward-looking data. Typically, we see Victoria as the leader in overseas migration. It's still performing strongly, but behind New South Wales at the moment. I would expect over time that Victorian data to once again be the top state performer, and that, of course, will have some positive impacts on the Melbourne housing market. We're seeing early signs of that with rents on the rise in Melbourne from a lower base compared to the other capital cities. I thought the other interesting data, which again, when we're looking at the annual trends, is no surprise, but we can look at just how strong net migration has been into Queensland, and it's really surging, and clearly at double the levels that we saw prior to COVID. Now we're seeing the growth in migration, net migration into Queensland. And of course, that's putting a lot of pressure on the southeast Queensland housing market, which still remains relatively affordable compared to Melbourne and Sydney. But certainly those prices, as we know and have discussed, are clearly on the rise in southeast Queensland. And no surprise given that constant surge in migration.
Well, our population's now reached 27 million people. The latest data, as you said, recently released by the Australian Bureau of Statistics, was for the September quarter. But if you go back, the intergenerational report in 2007 projected Australia's population wouldn't reach this figure of around 26, 27 million people for another 10 years to 2034, 35. And underestimating the population growth seems to be a systemic policy failure that compounds the challenge for delivering sufficient housing. How can the government project its work out what infrastructure is needed, what housing is required, if it can't get our population figures right, Andrew?
Well, that's right, Michael, but that's looking back, and we miss the mark in a lot of these projections and forecasts, don't we? And it's a question about the competence of high-level analytics, but that's another point. And I think we've had plenty of signs over the past decade that we needed to build more property regardless of population projections, and we've continued to flounder around the same old view of the property market and supply from our policymakers, and they're paying the price now with this terrible undersupply that we're stuck in.
Well, one of the other factors is that there don't seem to be enough workers. There's not enough workers to help build that 1.2 million homes that we're planning, or the government's planning, over the next 5 years. And those construction workers are also taken up by the big infrastructure projects. So I know the Master Builders Association and the HIA is calling for more targeted immigration, people with the right sort of skills.
Well, yeah, look, that's cliched response, isn't it, from that source, and that's fair enough. But more migrants mean more demand for housing.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. We're coming up to Easter, and last weekend was a super Saturday in the auction markets because there's a pause for a week. Lots more stock on the market. What happened? How did the depth of the market handle this?
Stunning weekend for auction activity, Michael. Really stunning. We've had a remarkable start to the year. Auction markets this year, we've never seen the volume of properties going through the auction market that we've had over the first 3 months of this year. Now, just a disclaimer here, we do have Easter early this year, so we tend to sort of front-end load data. The volumes come through earlier, so that's part of the story why we're seeing higher listings. It's the earlier Easter. So we won't know the full story until May begins, when we've got our holidays all behind us. But certainly the data so far has been extraordinary, and that was no different on the weekend. Of course, was Super Saturday, and there was no difference. Last weekend was a remarkable day for listings, and I thought it was really interesting because it was going to be a big test for the market with these flood of listings. But clearance rates basically held steady, which I thought was a positive result. It showed that the volumes of properties coming through were still absorbed by buyers out there, even though they had more choices, even though there was more competition amongst sellers because of that wave of auctions. So I'll have a look at the actual numbers. 1,136 auctions in Sydney, near record number of auctions, big number, 75.3% clearance rate, which is a very good result there. Certainly in favour of sellers, higher than the previous weekend, which was 71.3%, and higher than the weekend last year. When we look at the same weekend last year, it's not really comparing apples with apples because it wasn't the Super Saturday, because Easter's a little earlier this year. But nonetheless, it was a big difference, almost a half the number of auctions conducted a year ago in Sydney. But very good results there for that Sydney market, given that near record number of auctions. Melbourne also had a very big day, 1,516 auctions. Wow, that's a lot of auctions, near record number of auctions. Anything over 1,500 is a big day of auctions in Melbourne. 64% clearance rate, just a little bit lower than the weekend before, but gee, what a great result given that number of listings. We know Melbourne's been a relative underperformer in terms of its housing market performance, but still I'd say that given the number of auctions there, that sellers would be reasonably happy with those results. Well ahead of, in terms of numbers, of the same weekend last year, but the auction clearance rate's down a bit. Big weekend in Brisbane also for auctions, 130 auctions in Brisbane. We know that Brisbane clearance rate tends to be a little different auction culture in Brisbane compared to the other major capitals. But the 55% clearance rate is a good result there, similar to the weekend before. Adelaide down a little bit. It also had a big number of auctions. Adelaide's just showed some signs of, even though this is another good result, some signs of not being the super strong market it was last year. Still a good market for sellers, but not quite as strong as the year before, and where it had a clearance rate of 84%. And Canberra really continuing now, Michael, and we've discussed this, to show signs of a revival. 100 auctions in Canberra, 66.7% clearance rate. Very good result there for a Canberra market that's really been more or less in the doldrums for the last 6 to 9 months, Michael. And that's the highest clearance rate that Canberra has recorded for some time. We're not used to seeing a 65% plus clearance rate in Canberra. So good result there for the Canberra market. And again, sort of reiterating what we've said, that perhaps Canberra is looking to be a market to bounce back this year following, as I said, those quieter period last year. The Sydney market is tracking ahead of where it was a year ago. So March results are positive for Sydney. Melbourne just a little bit below where it was a year ago. Brisbane similar, slightly higher than where it was a year ago. Adelaide market similarly about the same as where it was a year ago. And as I just discussed, the Canberra market, when we look at the monthly results compared to March last year, the total results is certainly tracking higher than it was a year ago. And just to put it all together, Michael, we discuss clearance rates, we discuss listings, but at the end of the day, it's the number of sales that are, I guess, another key statistic, or perhaps the key statistic. So when we look at the number of sales, weekend sales conducted to March this year compared to March last year, we can see that Sydney is now tracking at 46.4% more sales over the period 2024 compared to 2023. Melbourne's up 30%, 30.6%. Brisbane up 35%. Adelaide up 14%. And Canberra up nearly 6%, Michael. So a lot of sales happening. Governments will be happy with all that stamp duty, Michael. Agents will be happy with all those sales and all that commission. But the doomsayers won't be quite that happy, Michael. But everybody's a winner, except for those that have predicted declines in prices again this year. And I don't think there's many of those voices around anymore.
I was just thinking that as I was looking at your chart, which actually showed how many more sales there are.
Yeah.
It wasn't that long ago that people were predicting fewer properties on the market. Others were, of course, predicting more properties on the market, but mortgagee sales. And that's actually not what's occurring at all.
No.
So the market's showing strong resilience. Australians are just getting on with their lives. Sure, they're going to take a break over the next weekend.
Yeah.
People are going to celebrate their Easter weekend. Others have got other celebrations. Look forward to catching up with you next week when we'll discuss what else is happening in our housing markets.
Yes, Michael, all good. Thank you.